In today's market update, we're going to be taking a look at the S&P 500. This is another video in the series in which we have been tracking a Hurst cycles analysis in the S&P 500 over the past several months. I've called this video a critical moment because the markets have reached a point where they need to show us one way or another which of the analyses that we have been considering is indeed the correct one. My name is David Hickson. Today is the 24th of October 2019, and as always I must ask you to please make sure that you have read and understood these disclaimers before we take a look at the markets. I'm going to start today's video with a look at the default analysis of the S&P 500 in Sentient Trader. As you might know from previous market update videos, I always keep what I call a default analysis in any workspace that I have. A default analysis is one in which I have not influenced the analysis that the software has performed in any way. And so this is a default, out of the box, if you like, analysis performed by Sentient Trader. I do this because over the years I've discovered that Sentient Trader often gets the analysis right, whereas I get the analysis wrong. It has been fairly humbling despite my years of experience as a Hurst cycles analyst. And so I always keep a default chart just to see what Sentient Trader thinks is happening. And this is the default analysis that Sentient Trader is providing me with at the moment. So the important features of this analysis, which are worth mentioning, are the 20-week cycle trough on the 3rd of June of this year, and then the 80-day cycle trough on the 26th of August, and then the 40-day cycle trough at the beginning of October. Now, when we take a look at another analysis in a minute, you can compare this analysis with that one, and I'm not going to dwell too much on the reasons why this analysis is as it is. What I would like to do is rather speak about the implications of this analysis. So the first implication is a fairly obvious one, which is that the 40-week cycle trough still lies ahead of us. There is the nest of lows for the 40-week cycle trough. Towards the end of the first week of November, perhaps towards the middle of November. And of course, the expectation is that the cycles will move price in an M shape up to that first peak, down to the trough of the 80-day cycle, then up to a peak of the 80-day cycle, which might have occurred over there, or which might still lie ahead of us. That is also possible. After having achieved that peak, whether it is here or here, price is expected to complete the M shape with a move down into the 40-week cycle trough. And so the implications of this analysis are clearly that price is going to come down into that 40-week cycle trough towards the middle of November. As a matter of interest, should the peak have occurred over here in about the middle of September, or should it have occurred about here, about now? Should it be occurring about now? Well, our expectation is that this particular 80-day cycle, as I mentioned in a previous market update video, should be less bullish than the previous one because it is coming down into a greater magnitude trough. So a less bullish 80-day cycle is expected to have an earlier peak. Okay, so therefore we would expect an earlier peak, but it's not a hard and fast rule. It is quite possible that price will poke up and provide us with another peak before coming down into the trough in the middle of November. Now, another way of understanding the implication of an analysis is to take a look at what I call the composite model line. This is a line which takes the results of the analysis, all of the cycle information, the wavelength and the amplitude of each cycle over time, and it recomposes that information and shows us how the cycle analysis explains the way in which price has moved in the past, and it projects it into the future. So taking a look at this composite model line, you can see it has explained price movement, if you like, in a fairly accurate way. There was a bit of an anomaly over here in the beginning of August, from the end of July, the first few weeks of August, where you can see price action didn't match the composite model line very closely. It was an interesting time, and if you go back and take a look at the market update videos that I made at that time, you can see that this move down although it was expected, and you can see it was expected in the composite model line as well, it was a lot stronger than was expected. And so that's a little bit of an anomaly. It doesn't rule out this analysis by any means, but it does highlight the uncertainty that surrounds the magnitude of each one of these troughs that formed in August. Of course, it would be wonderful if we could always be 100% certain of our analyses, but that is almost never the case. There is always some uncertainty present. You can see that the composite model line has again matched price action fairly well from about the third week of August right up until this period of time, roughly over here, about 2 weeks ago. So we had a good match over here. I'll try and write the word good. And following about 2 weeks ago, we have not had such a good match because price has been continuing to rise, whereas the composite model line has already started dropping down. So that, again, is a bit of an anomaly, and it does certainly raise the question as to whether this analysis is actually the correct one. So let's take a look at the other possibility. In my opinion, there is only really one other possibility, and here it is. The big difference with this possibility, as you can see, is that the 40-week cycle trough did occur at the beginning of October. Now, this is certainly a very viable and very valid analysis, and we need to keep paying attention to it. In my opinion, it's a less likely analysis, and as you can see from these pin symbols at the foot of the chart, I've had to do some influencing of this analysis. Those pins indicate that I have suggested to the software that that is a trough of that magnitude, and the software has complied with my suggestion, and it has positioned that trough. So this is a less likely analysis, but it's a very possible one. And this is why I've called this video a critical moment, because the market now needs to show us which of these two possibilities is indeed the correct one. And so let's take a look at the implications of this analysis, and we will do that again by taking a look at the composite model line. So the composite model line shows quite clearly that following the trough of the 40-week cycle, we expect price to move upwards. And so it gives us a completely different expectation in terms of what to expect to happen now. So we can look at this composite model line and compare its accuracy in terms of showing us how price moved in the past. The interesting thing about the composite model line, according to this analysis, or based upon this analysis, is that the anomaly that we experienced in the other analysis in August is no longer present. You can see the composite model line matches the price action much more cleanly throughout August. However, the composite model line has certainly diverged from price action from about the beginning of September. You can see price moved up over here, whereas the composite model line was expecting a very small little move up. Then, of course, price moved down, and the composite model line was also moving down. But, of course, the really big difference is that the composite model line shows us a lower 40-week cycle trough forming over here, whereas in fact price formed a higher trough. And that is an important difference, and it certainly does bring into question the validity of this analysis. So both analyses have questions and some anomalies, but both analyses are possible. How can we possibly resolve the difference between these two completely contradictory analyses and make sensible trading decisions? Well, let's turn to my trusty favorite Hurst Cycles tool, the FLD, or Future Line of Demarcation. This is a simple line that you can plot on your chart. The future line of demarcation is actually a very simple line to plot. It is simply the median price displaced into the future. It is displaced by half of the cycle wavelength upon which the FLD is based. And that is the key, is that you need to have performed a Hurst cycles analysis in order to plot a valid future line of demarcation upon your chart. So here is the FLD for the 20-day cycle, and as you know, I really enjoy working with the 20-day cycle FLD. I find it a very powerful tool, and in particular I track the interactions between price and the FLD. So what is an interaction? An interaction is simply whenever price does something relative to the FLD, such as crossing it. And you can see that price crossed up above the FLD over here in the second week of October. And you also probably know, if you've watched previous market update videos, that I label the sequence of interactions between price and the FLD using the letters A through H. And according to this analysis, with the 40-day cycle trough over here at the beginning of October, this was an E category interaction. We would expect price to rise up and fulfill an upward target calculated by the distance from the trough at the level of the 40-day cycle trough up to the level of price crossing that FLD. So in this case, the E category interaction projects a target of about 30.80. Clearly is a target that has not been achieved yet, because price has only reached up to about 30.15. So is this a failure of the system? Not at all. I should point out, as I have already mentioned, in terms of these two peaks of the 80-day cycle, according to this analysis, and this is of course the default analysis that we're looking at here, and the second peak is expected to be lower than the first peak. And so I'm not surprised that this E category interaction has not achieved its target yet, because we don't really expect it to get there. Nevertheless, there is the potential for it to reach up to that target. However, with the 40-week cycle trough looming ahead, and we're really not very far from when that 40-week cycle trough is expected, the next interaction between price and the FLD is expected to be an F category interaction, as price crosses down below the FLD on its way down to the 40-week cycle trough. An F category interaction is usually a good short trading opportunity. And so, according to this analysis, we have a short trading opportunity lying ahead. It's an F category opportunity, and it should give us a good short trade for the move down to the 40-week cycle trough. Now, what about the other analysis? Let's take a look at this other analysis, which of course is the one that I have influenced. And we will look at the 20-day FLD on this analysis as well. Here is price crossing up above the 20-day FLD. It's in a slightly different position because, of course, this FLD is based upon a different analysis, and so it has calculated a different average wavelength for this cycle. And the target for this price cross is just a little lower at about 30.75. But now the important thing about this analysis is, because this is the first interaction following a trough of at least 80-day magnitude, this is therefore labeled an A category interaction. Now, A category interactions we expect to achieve their targets and often exceed them. So this analysis certainly warns us that there is a good deal of bullishness ahead of us. In fact, we have almost 70 points to go in order to achieve this target. But how does this FLD help us to resolve our uncertainty in terms of making trading decisions? Well, that is very simple. According to this analysis, the next interaction between price and the FLD should be a B category interaction. Now, a B category interaction is where price comes down to the FLD, finds support, and then bursts upwards again. And the B category interaction with the 20-day FLD is expected at about the time of the 20-day cycle trough. Here is the nest of lows for the 20-day cycle trough. And so that 20-day cycle trough has been expected over about the past week. It could still form now. In fact, if we count the bars from that 40-week cycle trough, you can see that there have been 21 days since that potential 40-week cycle trough formed on the 3rd of October. Now, the average length of a 20-day cycle is 17 days. If you don't understand that, please make sure that you take a look at our 10 core concepts free download that explains some of these fundamental concepts of the Hurst cycles approach. And so that 20-day cycle trough could in fact be about 4 days overdue. It is possible, certainly, that that 20-day cycle trough formed on this Friday, the 18th of October. And so, to get back to how the FLD helps us to resolve our uncertainty in terms of the analysis. If price continues strongly upwards, that would be an indication that the analysis we're looking at the moment is in fact the correct one, and the price is bouncing out of the 40-week cycle trough, and we can expect a good bullish move all the way up to about 30.75. On the other hand, if price comes back down to the 20-day FLD at this point, and then crosses down below it, then we are expecting the move down into the 40-week cycle trough, because this would then be an F category interaction, giving us a good short trading opportunity. So we cannot simply jump to a conclusion about what is happening right now. We need to observe what happens in the markets. We need to observe in particular the interaction between price and the 20-day FLD. If that 20-day cycle trough lies behind us and price has found support at a level a little bit above the 20-day FLD, then we'll be feeling bullish and the market will have revealed itself. On the other hand, if price comes down to and crosses beneath the 20-day FLD, usually in a good, fairly strong price action, then it again will have shown itself and it will be on its way down to the 40-week cycle trough. I do hope that you found this market update interesting and useful. Please let me know if you have any questions in the comments below this video, or send us an email.